Hey, what's up? I'm Russ, and on this channel, we talk about making money primarily through dividend growth investing. And check it out, I just exited a position where this REIT was yielding over 8%, but there are just too many headwinds, and I'm not comfortable with it. Now, one of the first lessons that you need to learn as a dividend investor is you don't just buy the dividend, or you don't just hold on to a stock for that dividend. You always have to buy the business if you are going to be a successful dividend growth investor. So we're buying businesses first and then getting the dividend second. And when it comes to my investments, I like to sleep like a baby and not have to worry. Well, I'm worried. And it's because of this worry that I am out on Omega Healthcare Investors, ticker OHI, which was founded in 1992 and is the largest publicly traded REIT in the USA that is dedicated to skilled nursing facilities, or SNFs, which those take care of seniors who have significant physical or memory impairment, as well as patients who are discharged from hospitals but they still require care or rehab before they can be sent home, such as physical therapy following hip replacement surgery. Now, Omega is a triple net lease landlord, meaning that the tenants pay all of the property-related expenses. So as long as the tenants are doing well, Omega's doing well. And it's because of this that it's got me so worried about Omega Healthcare Investors. First off, I wanted to say that I think Omega is a very well-run company, very well managed, but there are factors, as you're going to see, that I think are beyond management's control that are causing them to have to get financially creative, and it was just too much for me. So when COVID hit, their occupancy fell from 84%, which is already low, to 72% in January of 2021, and currently sits at 75% occupancy, while their largest tenant only accounts for 8.5% of revenue. In 2020, the U.S. federal government created the Provider Relief Fund that will distribute a total of $186.5 billion to aid healthcare service operators. But since Q1 2022, STIMI funds are down 17% from $47 million to $39 million, and that's affecting operators having trouble paying rent due to increased costs. So I'm not thrilled with a large chunk of Omega Healthcare's tenants being dependent on Medicare and Medicaid and those STIMI funds. So that's a lot of government money that's coming in. And I don't like seeing that dependence, because if the political winds start to shift, things can change pretty rapidly, and we see they already are with the passage of the Inflation Reduction Act. And speaking of operators struggling to pay rent, AgeMo, accounting for 6% contractual rent, hasn't been paying and has restructured with OHI. Their tenant Guardian didn't pay in Q1 of 2022, but has also restructured and has resumed rent payments. An operator they don't mention, representing 3.4% of Q1 annualized contractual rent and mortgage interest revenue, did not pay any of its Q1 contractual rent and asked for a short-term forbearance. But during the second quarter, this operator did pay their full Q2 rent and interest obligations of $8.8 million. Another operator, representing 2.4% of Q1 contractual annualized rent and mortgage interest revenue, did not pay its March contractual amounts due under its lease agreement. And an operator accounting for 2.2% of Q2 22 annualized rent and mortgage underpaid. So OHI withdrew a $5.4 million letter of credit held as collateral to put $550,000 towards the June rent. So we see that several of their operators are really struggling to make all of their rent payments, and it's just got me worried that these are the canaries in the coal mine, and this could spread to other of their operators that haven't started to show problems yet. So this leads us to the dividend. What about the dividend? Is that dividend secure? Now, SimpliSafe Dividends shows that their adjusted funds from operation payout ratio is 93%, which is well above the 80% that SimpliSafe Dividends feels comfortable with. And their AFFO growth is still negative, but improving, while their sales growth has been been choppy, it is still positive but declining. OHI's net debt has been steadily increasing and is currently at 57%, while their price to AFFO and dividend yields are pretty much at their 5-year averages, so not really a good bargain right now either way. And their share price is almost 35% above their 52-week low. OHI is currently paying $2.68 a share annually every February, May, August, and November, and that dividend has been frozen since October of 2019 and has a 10-year CAGR of only 5%, but OHI has not missed a dividend payment in 18 years, according to Simply Safe Dividends. So the icing on the cake for me was CEO Taylor Pickett being cautiously optimistic when he said that the metric to look at regarding the dividend payout is FAD, or funds available for distribution, which is currently at 94%, and he thinks when their tenant age mo resolves, they'll push back down into the 80s, but if that perspective changes, they'll relook at their dividend policy. So that's really what did it for me. When you have the CEO saying that when one tenant gets things back on track, things are going to resolve themselves, but if the perspective changes, they'll relook at their dividend policy. Yeek. We don't hear companies like Johnson & Johnson, Procter & Gamble, or Realty Income talking about relooking at their dividend policy. Now, even if it was a 50% dividend cut, that would still be yielding over 4%, but I think a lot of investors would exit, and that would really push the stock price down. And I hope I'm wrong. And for those of you that continue to invest, I wish you the best of luck. And it's because of these issues, plus a few others, that Simply Safe Dividends rates their dividend safety as unsafe 40. So I exited Omega Healthcare Investors after the recent run-up by selling a covered call that, coupled with the dividends I've received, I basically broke even. So I sold OHI at around $33 and got about $3,300 plus option premium, and I'm using some of that cash to sell covered calls and cash secured puts on companies like JP Morgan Chase and Starbucks, and I'm using the option premium to invest in and buy a more stable REIT right now, in my opinion, which is Store Capital, ticker STOR, which has a Simply Safe dividend score of 70, a dividend growth streak of 7 years, and a yield that's about 23% above their 5-year average, is about 11% off the 52-week low, and has an AFFO payout ratio of 68%, which leaves a little bit of wiggle room, and net debt that's only at 47%. And unlike OHI, they have 99.5% occupancy, with their largest source of revenue being only 2.9% from one tenant, while their top 10 customers account for only 17.7% of base rent and interest. Now, we would all love to hear it around here if you are invested in OHI, if you're going to continue investing in Omega Healthcare, and if you are nervous or worried like I am, or I was, about Omega Healthcare. What do you plan to do? Share it in the comments below, because you know where the comments go, and in this itty little teeny tiny itty bitty box next to my head, you can check out the 10 dividend stocks I covered that beat the last recession. And if you click on that little box, I will talk to you there.